Opera and the firm short-selling its stock, alleging Africa fintech abuses, weigh-in. Internet services company Opera has come under a short-sell assault based on allegations of predatory lending practices by its fintech products in Africa. Hindenburg Research issued a report claiming, among other things, that Opera's finance products in Nigeria and Kenya have run afoul of prudent consumer practices and Google Play Store rules for lending apps. Hindenburg, which is based in NYC and managed by financial analyst Nate Anderson, went on to suggest Opera's US-listed stock was grossly overvalued. That's a primer on the key info, though there are several additional shades of the who, why, and where of this story to break down, before getting to what Opera and Hindenburg had to say. A good start is Opera's ownership and scope. Founded in Norway, the company is an internet services provider, largely centered around its Opera browser. Opera was acquired in 2016 for $600 million by a consortium of Chinese investors, led by current Opera CEO Yahui Zhou. 2 years later, Opera went public in an IPO on Nasdaq, where its shares currently trade. Though Opera's web platform isn't widely used in the US, where it has less than 1% of the browser market, it has been number one in Africa, and more recently a distant second to Chrome, according to StatCounter. On the back of its browser popularity, Opera went on an African venture spree in 2019, introducing a suite of products and startup verticals in Nigeria and Kenya, with intent to scale more broadly across the continent. In Nigeria, these include motorcycle ride-hail service A-Ride and delivery app Afoul. Central to these services are Opera's fintech apps, Opay in Nigeria and Okash and Opsa in Kenya, which offer payment and lending options. Fintech-focused VC and startups have been at the center of a decade-long tech boom in several core economies in Africa, namely Kenya and Nigeria. In 2019, Opera led a wave of Chinese VC and African fintech, including $170 million in 2 rounds to its Opay payments service in Nigeria. Opera's Africa fintech startup Opay gains $120 million from Chinese investors. Opera's fintech products in Africa, as well as Opera's cash bean in India, are at the core of Hindenburg Research's brief and short sell position. The crux of the Hindenburg report is that due to the declining market share of its browser business, Opera has pivoted to products generating revenue from predatory short-term loans in Africa and India at interest rates of 365 to 876%, so Hindenburg claims. The firm's reporting goes on to claim Opera's payment products in Nigeria and Kenya are afoul of Google rules. Opera's short-term loan business appears to be, in violation of the Google Play Store's policies on short-term and misleading lending apps. We think this entire line of business is a. For more on this story, visit the news article link.